Welcome to Wealth Preservation Solutions. I'm Elizabeth DeLeo, Director of Family Offices. Kevin Ellman, CFP, our CEO, is here with me today. Hi, Kevin.
Hi, how you doing?
I'm very well, thank you. So, over the last year or so, plus at this point, we've been experiencing some really significant, what I'll call current events, right? Between the pandemic and the presidential election, and now that's settled, but the pandemic is we're working our way out of the woods, right? The vaccine is being rolled out. So what we wanted to take a minute today to do was to kind of take a step back, take a step away from such current events and talk about the fundamentals, some of the fundamentals that we follow here when it comes to building an investment portfolio and how we just kind of approach the overall market when it comes to specific investment choices.
Sure. So we try to follow a disciplined, systematic approach whenever possible.
Mhm.
For a lot of people, investing is pretty emotional. There's a real tendency to get excited when things are going well, and a real tendency to get scared when things are not going so well. And we've had both those extremes this past year.
Mhm.
So one of the things that people are always asking me after they ask, what do I think is going to happen next, is they'll take a look at their portfolio and they'll see that, oh, well, last year, large cap stocks did really well. And it's like, well, why don't we own more? Or they'll say, well, emerging markets was the best performing, asset last year. Why don't we buy more? So there's a real tendency to do what I call chase the hot dot. So whatever was doing really well, most recently, let's buy more of that.
Mhm.
And of course, everybody has heard this notion of, buy low, sell high, but nobody wants to do that.
Mhm.
When something is low, like say last spring, if I called somebody up and say, hey, the market's tanked, let's buy some more. People say, oh, it sounds great, Kevin. I got another call, gotta go.
Right. It's fearful, it's scary to think that you're jumping in blindly, but you're not. We understand the concept behind that, but just that feeling of loss, when you're in the midst of experiencing loss, to go in and potentially make less, a lot of people are fear-based.
Exactly. And of course, if the market's down, in the middle of a pandemic, it could get worse.
Sure.
But if you're
Scary.
buying after the market's collapsed 30%, your chances of having gains over the long haul are better than when it was up 30%.
Right.
So, if you just took two choices and said, okay, I'm going to buy last year's best performing asset class or buy last year's worst performing asset class, if you bought last year's worst asset class, you would do better over the long run by a large margin. But, nobody can do that. So what we try to do, rather than predict what's going to be the next hot asset, what's going to be the next thing, because that's very difficult to do. I mean, we feel comfortable looking at the overall direction of the market, but not picking winners. That's really a challenge.
Mm-hmm.
So what we do instead is we put together a diversified portfolio, which is
Mm-hmm.
going to include large stocks, mid-sized stocks, small stocks, international, emerging markets, bonds, sometimes gold, sometimes real estate, depending on the period of time. And over the long haul, that diversified portfolio, it's never going to be the best, but it's also never going to be the worst. And it's always pretty much going to give us a pretty steady Eddie, solid return.
Mm-hmm.
So if the best stocks are doing like, 9.5, 10%, and bonds are doing 4% or so, well, our diversified portfolio, if you blend that all together, might be, 7 or 8%.
And something that is a theme that throughout all of the conversations that we've had and that you've had with your clients over the last several decades is that it's not what you buy. It's not even when you buy, right? So it's so much what the phrase that you use is, it's not timing the market, but it's
Time
time.
the market.
Exactly.
So the thing we've also seen, that timing the market is unbelievably difficult.
Mm-hmm.
Some people can manage to sell before the market collapses, but then they're terrified of buying back in.
Right.
The big thing is that most of the studies show that the market doesn't go like this in a steady rising, positive
People would
return.
sleep pretty well at night if that was the
Yeah,
case.
but it's like this.
Right.
It's like the example I use. You pretend you're on an escalator and the market is, you're playing with a yo-yo. The market is going up and down. The underlying trend is up, but the day-to-day movements are all over the place.
Right. And when we take a look at this diagram here that kind of shows the ins and outs of the market, right? Where one stock or fund landed itself in the market at a high and it followed the market out and came out of the market at the end of the year at not so much of a high. Most people would take a look at this and say, well, what's the pattern? Maybe I can identify a pattern that I could follow over the years. And what we recognized is the pattern is there is no pattern. Would you agree?
That's the problem. I mean, I like to show this quilt to people and say, well, can you find a pattern? I mean, there's just no rhyme or reason to why, when you look at it, why things are doing well or not well at a particular time. So the other thing is that if you miss, the course of the year, if you miss a couple of the big days, you really, diminish your returns.
Mm-hmm.
So it's important to stay in and stay invested. So
Mm-hmm.
then for sure you're going to capture all the upside. In and out, you could miss it.
Exactly. And we had a very interesting conversation with one of our clients earlier about his approach to how he views the ups and downs of the market. And he said to us that when the market's up, he looks. When the market's down, he doesn't.
That's pretty
And
good
it's
advice.
it's almost like it's a very emotionally intelligent way because we're all emotional about our money, but it's a very emotionally intelligent approach to, I guess, just monitoring your feeling about the volatility in the market.
Well, yes, he happens to be a particularly smart guy and a successful business person. And, it sounds silly because, the other extreme is people are looking every day and getting nervous and getting worried
Sure.
and up, and what do I do? What do I do? Having questions. I
Mm-hmm.
think his approach is much better. So he steps back, gets a
Mm-hmm.
little distance, and let things grow.
Mm-hmm.
Another example I use all the time, which is, imagine you're planting a garden.
Mm-hmm.
You plant a tree in your backyard. You know that it's going to take 10 years for it to grow into something. So you
Mm-hmm.
don't go out every day and say, did anything happen? Oh, I think I'll measure this branch here. Did it get a little bit bigger? And then
Right.
what happens if there's a lightning and it knocks off a branch?
Oh,
Pull out the tree.
devastating.
No, you have to let
Right.
it grow. You gotta fertilize it, water it, whatever else you do. Not that I know about plants, but you
So
gotta
you've heard.
let your garden grow. And
Mhm.
that's kind of the approach to investing. You got to step back and let things grow.
Sure. Absolutely. So, we went back to the fundamentals of some investment strategy. We've talked about the quilt that illustrates very well the patterns of the market, which there is no pattern, where there's no predictable pattern. We may be able to go in history and make some sort of sense out of it, but in terms of from a future predictability standpoint, it is purely impossible to predict. You can speculate, obviously, based on history and based on current events and what's happening. So, one of the things that we often will speak to our clients about is not just their investment portfolio, but their overall planning and just making sure that it's aligned with what their goals and objectives are. And that's what we call in our world a wealth stress test. And so, what I'd like to do is invite everyone to our website to complete a wealth stress test and just get a better idea of where you're at, where your plan is at, and where you would like it to be if it's not aligned with your actual goals and objectives. And once you do that, we will be able to contact you to discuss what the results are. And as a secondary result of doing that, you will
I'm ready.
receive a complimentary copy of Paul and Kevin's newest book, Can Your Family Wealth Management Plan Pass the 360-Degree Stress Test, which in and of itself is our process here at Wealth Preservation Solutions, a 360-degree family wealth management. And so thank you for joining us today. Kevin, thank you for walking us through the quilt, as we like to call it. And for everyone watching, please visit our website. It's wealthpreservationsolutions.com. In addition to completing the stress test, if you'd like a copy, or aside from completing the stress test, if completing the stress test is not something that you'd like to do right now, but you would like to learn more about our process, please text wealth to 88799 and we'll send you a free copy of the book. And until then, everyone, stay happy, stay healthy, and stay wealthy. Bye.
Bye.